Well, hello and welcome to this special IM Global Partner Focus, where we're going to take a closer look at DBI and the world of liquid alternatives. Here to do that, I'm delighted to welcome Gregg Clerkson, Director of Global Asset Management at IM Global Partners. Hello, Greg.
Hi, Julian. Thanks so much for having me.
Well, let's start with an obvious question. IMGP is a relatively new name, certainly for some UK fund selectors, financial advisors. Can you tell me a little bit more about the business?
No, absolutely. So IMGP, as you say, is relatively new to the UK advisor market, but our first office was actually here in London. And we were founded about 10 years ago and have grown pretty rapidly. We're about 45 billion in AUM now and just over 85 employees. And our business model, we think, is quite unique in the sense that we take minority stakes in kind of entrepreneurial and fast-growing investment managers, which we call our partners. And the reason it's that minority stake is that we want those people that founded these firms that really drive their growth to stay involved. We're not there as a cash out. We're there to help them grow and grow together. And it's been, well, we think, a pretty successful partnership so far. So we now have 10 partner managers, from equity to fixed income to alternatives. And, we're very purposeful about the type of businesses we partner with. There's really no overlap between our managers. We're trying to be very strategic about our lineup. And also the one thing that really links them together, or the common thread, if you will, is that we think they have the ability to make a portfolio better. So if you look at an equity manager, that means the ratio of up capture to down capture versus the index tends to always be positive. And in the liquid alternative space, which we'll speak a little bit more about today, our partner DBI really has some impactful solutions on the overall risk return characteristics of a portfolio.
Okay, well, you mentioned liquid alternatives and DBI. Could you go into a bit more detail about what sets them apart from the market? What makes them special?
Of course, DBI's focus is on hedge fund replication, but specifically in bringing kind of previous complex solutions to investors in both a liquid and fee-friendly manner. Now, what they do is, it's an area that our investment team, our research team, had looked at before, but never found a really compelling solution until we partnered with DBI in 2018. And at that point, DBI's AUM was about 250 million. We've had really nice performance since then and grown to 2.5 billion, which obviously has been good for both DBI and ourselves, but for our clients too.
Thank you. That's the who and the what. Can we drill down a bit more into how they actually do what they do?
Of course. DBI's replication process looks at replicating the performance of hedge funds by looking at historical price returns. So what that means is that it's suitable for some things, but not suitable for others. And so we avoid areas such as arbitrage or strategies with a lot of optionality in them, because the price return doesn't tell you what's going to happen next. Whereas areas such as equity hedge strategies or managed futures in particular are very suited for this approach. And so in the UK, we have two main strategies that we work with investors. One is the multi-strategy approach, and the vehicle there is the SEI Liquid Alternatives Fund, which DBI are a sub-advisor to. And then we also have a standalone managed futures strategy, which is the IMGP DBI Managed Futures Strategy.
Sticking with the practicalities, how have you been seeing UK fund selectors, other advisors, professional investors using these sorts of products?
Managed futures are a pretty unique strategy. The SGCTA index, which is the one which we replicate, was founded in 1999 and has produced a mid-single digit return and kind of commensurate volatility. That in and of itself is not very exciting until you look at the fact that it's produced those returns with zero correlation to both equities and bonds over that entire period. Probably even more interesting from an allocator perspective is the fact that as an asset class, it's really outperformed in times of market stress. So if you look at the dot-com bubble, the 2008 financial crisis, or more recently in 2002, CTAs produced positive returns through all three of those periods. So it really did some heavy lifting from a portfolio context. And as allocator and allocations change from kind of your traditional 60 equities, 40 bonds to more perhaps 50 equities, 30 bonds, and 20% something else, we really think something that is liquid, accessible, and have that portfolio impact can really work within a portfolio context.
Final question, big question. Why go for hedge fund replication? Why not invest just in the funds themselves?
No, it's a really good question, and I think there's, well, what I hope are three really good answers. The first one is that DBI replicate hedge fund indices, not individual hedge funds. And the hedge fund indices themselves are a peer group. So in our case, when we're looking at managed futures, it's the SocGen CTA index, which is the 20 largest offshore CTAs in the world. To actually invest in that as an investor, you would need multiple millions of dollars. You'd be able to try and get the capacity with these managers, which is questionable in and of itself. So it's not an easy task. So just the sheer ability to invest in the index is something that we're bringing to investors. The second one, and this is where the DBI strategy is quite unique, is that we replicate the gross of fee, not the net of fee returns. Hedge funds are notorious for high fees. 2 and 20, I think 2% management fee, 20% performance fee is kind of the old standard in the industry. Not to mention these funds are touching the markets multiple times a day and have pretty high implementation costs. DBI charge a low flat fee, and that difference month on month between the 2 and 20 or the high management and high performance fee and our low flat fee accrues right to the investor month on month, year on year. It's a very consistent form of outperformance that we can generate. And finally, as I mentioned a little bit before, the implementation is very liquid. We use 10 futures contracts in our implementation. What that means for investors is that they can move in and out in size at very low transaction costs whenever they want. So you're not faced with typical issues of some hedge fund strategies of illiquidity or being stuck in an investment when you want to exit.
Thanks, Greg. Very clear answers to a potentially complex subject. Thanks for your time.
No, thank you very much.
And thank you very much for watching. Please look out for further videos in this series.